Hey everyone, I'm so excited about today's episode, but first want to let you know that this show is made possible by FortuneBuilders. I also want to take a minute to invite you guys to an amazing opportunity to learn from some of the top experts in the real estate industry about how to get started in real estate or scale an existing business to the next level. FortuneBuilders is hosting a one-day webinar to help you learn about real estate investing in today's market. So throughout the show, if you feel like you're ready to get started, go to FortuneBuildersShow.com to register. Again, that's FortuneBuildersShow.com to register. If you're watching on YouTube or Facebook, you'll find a link right below the show so you can get there that way as well. And please remember that the content of this show and every show is for educational purposes only. Myself or our guests are not going to be providing any legal, financial, or professional advice. If we share specific results, they are attributed to an individual or a business, and we can't guarantee the results will happen for you, those earnings or the income will match those figures. The bottom line is there's always risk when investing in real estate. You can make a lot of money or you can lose a lot of money, and it's hard work. But that doesn't mean we can't have fun doing it. So let's get into today's episode.
From a team that has $1 billion in real estate investment experience. A show to help you learn the strategies and systems it takes to get started investing in real estate. This is the FortuneBuilders Real Estate Investing Show.
Welcome everyone, Paul Shively here is your host of the FortuneBuilders Real Estate Investing Show. We have an absolute special treat for you today. Recently, Merrill interviewed the economist David Childers, president of Keeping Current Matters. And if you don't know David, he is an absolute rock star when it comes to helping what all of us investors want to know. How do we predict the future, right? What's going on in the economy? How does it affect real estate? We're seeing a lot of headlines right now about inflation and real estate and the Fed adjusting the interest rate. There's a lot going on right now. So we thought it was incredibly timely to get one of the people we look to, that myself, that Than and Paul and JD look to when it comes to helping us look at the economy and help make better investment decisions, more educated investment decisions right now on what's going to happen in the economy. And for this show, the term of the week is economic future. David Childers, the rockstar economist, is going to be teaching us, and Than does a wonderful job interviewing him to help us gain insight into what's going to happen to the future of our economy. But also here, the reason the term of the week is economic future is how does that affect your economic future as well too? How are you going to take the education you're about to receive from Than and Mr. Childers and implement it into your business to help impact your economic future? So you're in for an absolute treat today. I've got my cup of coffee ready as well too. I've got my notepad. Hopefully you do too. Enjoy.
All right, welcome everyone to the webinar. This is Merrill. I'm here live with Mr. David Childers. And David, how are you this fine afternoon? This fine, what's today? Wednesday? I'm trying to.
It is. It's Wednesday. I'm doing great. Thanks for the opportunity to join you and just talk a little bit going on in the housing market. So excited to talk about that.
That'll be great. And I know we have people. This is a live webinar, so towards the end, we will field a couple questions. We're going to have, we have a lot of people registered for this webinar today. So we're going to have probably close to 1,800, 700 people joining us live. So we won't necessarily be able to get to every question, but we do have the ability to ask questions. In the upper right-hand corner is the GoToWebinar control panel. If I see a couple common key questions, I will bring those up towards the latter half of the presentation. And some of you may recognize David if you've been with us, students with us for 3, 4, 5 years or greater, because David was a presenter at one of our annual Real Estate Ignite conferences. And we got great feedback, David. Everyone loved you. Everyone loved you. And
well, so, good. I'll tell you a funny story about that in a minute, but keep going.
Sounds good. My business partner Paul had the chance to interview him at Ignite. We also, as everyone is probably aware, and maybe some of you may not be aware, we do have Real Estate Ignite coming up November 11th to the 13th, and it's going to be live. We're going to be in Las Vegas, and the last 2 years we had it virtually, so we are very excited to get back together in person. But I wanted to have David on for a couple reasons. One, he was one of people's favorites to hear from at one of our past Ignite conferences, and two, David's bio and what he's been doing for the last 20 years is keeping his pulse on the real estate market. So he is the president of Keeping Current Matters. That is the name of his company. And give everybody the website just so they have it.
It's keepingcurrentmatters.com.
Keepingcurrentmatters.com. So if you want more information, right, you can find out more information about what David does. But he is a highly sought after expert in the housing industry and in the real estate industry, talking about things like housing prices, interest rates, inventory, inflation. The media turns to David for insights. Obviously, we are in a very interesting time, to say the least, in the real estate market. And there's a lot of different information out there. Sometimes the information is conflicting. Sometimes there's people that have different opinions. So it's always good to hear from people who really have their finger on the pulse, who are being interviewed, for podcasts and webinars about real estate and helping advise real estate investors and agents make better decisions and really better understand the information that economists are sharing, all different types of information. And so it's always important to get people's perspective. So let's jump right into it. David, let's take a step back before we talk about today, which is probably going to be 40 minutes or so of today's market. Let's better understand the past couple years. We went through this crazy COVID period that never been experienced before, and home prices. Everybody in early 2020 was, everybody, myself included, was unsure, afraid, fearful. And then the housing prices have been astronomical the last couple of years. Why has that happened, in your opinion?
Well, it's a great question, and I think more and more information is continuing to come out about that. And as we look back on this time, I firmly believe we'll look back on it as such an anomaly in the business. The biggest fear, you and I were talking before about doing interviews. I've been saying this, and I believe it with all my heart. The biggest challenge we have right now is we got used to the last couple of years in the gains and what was happening. And I want to talk about that, but here's sort of the breakdown of that. And I would say it this way: for people all across the U.S., the meaning of home changed during the pandemic, right? We started off in March of 2020, and it's kind of like, hey, we're all going to go home for 2 weeks, then this is going to be over. And then, thankful we didn't know all that was going to go on. We probably couldn't, everybody would have freaked out or something. But, after, that sort of initial panic of the pandemic, we saw the Fed act and drive down interest rates to, call it 2.75% on a 30-year fixed. You saw savings of the consumer grow, right? I'm not going on vacation. Maybe I got some stimulus money, whatever that is. And it caused this fury in the market where people said, we've been thinking about doing something. And at the affordability, the numbers that we can buy a home at right now, we're doing it and we're jumping in. And oh, by the way, with sort of the pandemic in the rear view mirror or in our mindset, we need something different for our family. We need a backyard. Our kids are going to school at home. We're spending more time there, and we're willing to pay for it. That's very clear. People said, we're willing to pay for it, and so I think there are a number of things that sort of converged on the housing market. One other thing being a fallout, or not a fallout, but a remnant of 2008 is people had equity in their homes. They said, we're going to do it different this time. And so they said, look, we can take that little bit of equity we have, we can move up, we can buy an investment property, we can buy a second home. We saw the second home market surge in this country. And I think we'll look back on this being a contributor of the amount of money that's in the economy and low interest rates that just fueled this, really, if we're honest, unsustainable growth in housing.
So to sum it up, low interest rates, high homeowner liquidity, low supply. If my figures are correct, I don't have the exact math, but in 2020, home prices, across the country were up, I believe, over 9%, and last year in 2021 was like 16% or something. And obviously that rate is unsustainable, from an affordability standpoint.
Sure.
Talk to us today. Okay, so here we are today. A lot of our clients are real estate investors. Some of them are also real estate investors and agents, right? So they may be buying for their own inventory and representing clients, but most are investors who are looking at buying rental properties, looking at buying homes that they fix and flip. Where do you think housing prices are going to go, this year and next year? No, I know nobody knows, but there's a lot of fear right now that home prices, could they fall? Are they going to be flat? Where do you think, based on the information you're assessing right now, housing prices are going?
Yeah, let me talk about that for a minute, because I think there is a lot of question in that. That's probably the number one question that we're getting right now. And just to give you a little bit of a snippet of what we do at Keeping Current Matters, not in a self-serving way, but more in a defining way. We have a team of researchers that scans everything coming out as far as reports in the real estate business. So anything that's published on prices, on days on market, on inventory, we scan all of that and say, okay, here's what's happening in the market. Reason that's important is we don't get that in the media. Like, let's be clear about that. We get, sensationalism, and we get fear, and we get all the things that we know about that. And we get these headlines that say the housing boom is over, and the housing bust is here, and all those things, which I don't think do a good job of accurately portraying what's happening in housing right now. So let me kind of break it down for you.
I think that's, before you do that, I think that's really important, because what happens is an uneducated homeowner or investor or consumer sees these things, that this is what they're talking about in their social circles, and the media is there to sell papers or get clicks, right?
Sure, right. And the job of the media is the job of the news is to get you to watch more news. That's our job.
Yeah. And so what you're talking about is really important, because you aggregate data, you aggregate economic data, you look at it and try to make sense of it and what's really happening. So I wanted to pause there, because depending on what you read and what your news outlet is, your viewpoint can be different.
And that's true in the world we live in, right? Yeah. That's not just housing. That's politically, that's everything that we do. And I want to say one other thing. I am not an economist, okay? I am somebody that grew up in the real estate business. My dad, actually, I'll tell you an interesting story, lost his job when I was in high school, and he turned to real estate. That's the truth. And he was like, you know what? I got a little bit of a profit sharing nest egg from the company that I worked for, and he went and turned that into rental property and has sustained my parents through retirement. Amazing. So that's been my life, and got into real estate. So what I try to do is take that and say, okay, what does that mean to folks that are out there like us, that are buying and selling real estate, to the agent that's out there maybe working with somebody buying and selling? What does it mean? And so there are a couple of things that I would break down for you right now. One is home price appreciation this year is forecasted to be around 11%. We saw 10% back in 2020, around 20% last year, and we'll tail out this year at about 11%. Average home price appreciation in this year is 3.8%. I mean, in this country is 3.8%. Remember, we started off, I said the biggest danger we have right now is we got used to the last 2 years. That's the biggest danger, okay? Because we're heading back into a market that is very, very normal. And I think it's one that's going to require us to get back to, grinding it out and working and making it happen. And so that's the picture for this year. Most of that appreciation was in the front end of this year, before interest rates now today knocking on the door of 7%, maybe in some cases over that. And it's sort of had this seizing effect to the market. okay? If you look into next year, I've just gotten 2023 forecast. And a matter of fact, if you let me share my screen, I'll give you a couple of things to show you about this, because what I think is important right now is that people understand the dynamics at play. So tell me, can you see this this graphic I'm showing? So this is price forecast for 2023 coming from all the major forecasters. Now, are there people on YouTube saying, you know what, the real estate market's going to crash and, you know, we're all going to die and, you know, we better get out now? There absolutely are. The good news is they have a book or something to sell you to help you get through it. So that's what their game is. But if you look at people that are reputable, that are forecasting home prices, one, Ivy Zellman's calling for depreciation. The rest are calling for appreciation. I think best case scenario, we're looking at what I'm going to call anemic growth next year, 2% in residential real estate. That's kind of the best scenario right now. Why is this important? It's important because what is going to get the press is the forecaster that says we're about to lose money. It's not going to be any of the ones that say, you know, this is what's going to happen. And the predominance of forecasters are saying, you know, we see, you know, appreciation going into next year. But there's even a bigger question at play. And here's the question I would encourage everybody to become a student of. Than, I'm going to send you these slides afterwards. You can get them out to everybody. And I would use this as I'm thinking about my perspective on housing. And it's, why are they calling for appreciation? And I can tell you this, we follow the home price expectation survey, which goes out 5 years, and they're calling for appreciation for the next 5 years in a much more normal fashion, 3 to 4% in residential real estate. And it has to do with supply and demand. And I'll show you a couple of graphics just to give a visual representation to this. So first one, the reason they're calling for appreciation in this country is because of this graphic right here. You see that graphic?
Yeah.
This is single family housing units completed going all the way back to the 70s. And post 2008, we've been below the 50-year average of builds in this country. Now, you think about that, builders got crushed in 2008. They had to get out of the market. And this will be the first year in 14 years where we build over 1 million units in this country. And builders understand there's opportunity. They understand they need to bring units to market. But if you read articles, they'll generally say we're undersupplied in this country in housing by about 3 to 4 million units, okay? So that's your supply side. You have less available inventory and you have more people that want to buy. That's simple economics. Oh, by the way, the question I get a lot, Than, is, okay, what about Wall Street? They're in here, iBuyers, you know, the BlackRocks of the world, they're buying up all these homes. They're not the predominance of the market, but the question you need to ask yourself is, why are they doing it? There's one reason. They know housing is a great investment. That's the reason they're doing it. And so they're participating. They're going, look, we can make an investment here. So first piece, we don't have the number of units in this country that we need. Second piece that's critically important is you have the largest demographic in history behind the baby boomers moving through their peak home buying years. We know statistically the peak home buying years in this country are 22 to 34. And I'll give you a couple of just shocking statistics. Last year, 81% of first-time home buyers in this country were millennials.
Wow.
81%. That comes from NAR's annual report on home ownership. 43% of all buyers were millennials. So let's go back over this. We have less inventory and less available homes. You have a massive amount of people that want to buy. That keeps upward pressure on prices. We're dealing with dynamics in the market. And I'm going to take these slides down real quick that we haven't seen, you know, going back to 2008, very, very different scenario. That I think the outlook for real estate, if I were to say, okay, am I buying now? Am I looking at that? And certainly depending on your strategy, you've got to make a wise decision there. But the long-term strategy in real estate, oh my gosh, it's unbelievable. You can just look at the dynamics in this country and say housing is a great investment.
I completely agree. I mean, when you look at 2008 and just the inventory compared to today, right? That's why I feel really comfortable, because housing is supply, real estate is supply and demand. And in 2008, with the sheer number of homes available for sale, the cost of construction was significantly less than it is today. And
Right.
we're in a completely different market. Now, we are in a market that's, really interesting, because, talk about what defines an economic recession, and then what would you, because that's different than, a housing recession, right? Talk
Yeah,
about,
sure.
where we are with just the economic recession as a whole and how you define that.
So, it's interesting. We've done a study on this at Keeping Current Matters, and I always say, I thought there was one thing we probably couldn't argue about in this country, but apparently recession is one of those things we can argue about as well. So you would have to go all the way back to the 40s in this country to find a recession that was not 2 consecutive quarters of negative GDP. So what did we see in the first quarter and second quarter this year? We saw negative GDP. That typically has defined a recession in this country. Again, you'd have to go back a long, long time to find an outlier to that. Now you have this National Bureau of Economic Research, which is a government agency that calls a recession, that technically says when we're in a recession and we're not, which is a widespread downturn in the economy. So, depending on what you believe politically or whatever, whenever in a recession, you'll be told. That's the bottom line, okay? A recession is only a term for a slowdown. What is very clear right now is the Fed is acting to slow this economy down. Inflation's out of control, and they're trying to do that. And we can debate whether they're doing a good job of it or creating confidence in their ability to slow it down and all those things. But it's a slowdown. Here's the interesting thing. Ever since 2008, the term recession took on a new meaning, because families got hurt, individuals got hurt, people had to sell a home, people worked for years to recover from that. And so when that word gets thrown around, people almost go back there and they're like, you know what, the last 2 years felt like the years leading up to 2008. And if we're honest in this business, we need to go, yeah, they kind of did. Yet we're in a very different scenario, but people have a reaction to this. Now, let me tell you where I'm taking this. All of a sudden, people come up and they're like, we're in a housing recession. Well, here's the bottom line. There's no precedent for a housing recession in this country. That's not a term that's been coined, or one that we would say, okay, this is NAR has a definition they've come up with. But when people see housing and recession, they think, here we go again.
Mm-hmm.
And I don't think it does a good job of saying, is housing slowing down? Absolutely. We're seeing that. If you own an Airbnb and a rental, are you in a housing recession? No way.
Mm-hmm.
And so I think we have to be very, very careful about buying into that. And today in the world we live in, one of the best questions we can ask someone is, what do you mean by that? If somebody says, hey, I think we're in a housing recession, what do you think? I say, what do you mean by that? Is housing slowing down? Absolutely. Is housing tanking? No way. And I can give you some just pure hard facts to dispute that and show people that will blow people away, that they don't. Again, I'll go back to what I started with. When you turn on the news, you don't hear that. What you hear is, guess what? Homes are appreciating at a slower rate than what they were before. There's not as much sales happening, all true things, but they lead people to panic.
Yeah. Talk about housing affordability. This varies depending on what market you're in. If you're in Ohio, housing affordability versus in San Francisco or San Diego, where I live, may be talked about more or less depending on what market you're in. But
Sure.
Why don't you define what makes up housing affordability and what impacts housing affordability, so people have a better understanding of that?
Yeah, okay, so I want to distinguish this conversation in 2 ways. There are 2 things that are commonly talked about in our business. One is affordable housing, and the other is housing affordability. They're 2 separate things. Affordable housing typically refers to homes on the lower end of any market that, let's call it a first-time home buyer home. There is not a market in this country, unless you want to put it in the chat. And you're like, we have plenty of first-time home buyer inventory in our town or in our area. Everywhere across this country, we need more homes on the lower end. There's a crisis in affordable housing in this country. There's even actually a bigger crisis going on, but we want to see people be able to buy a home. I mean, that's the American dream. The number one wealth creator in this country is real estate. That's a fact. The way that the majority of people build wealth in this country is through real estate. So that's affordable housing. We want to see people get into houses, and if they can't, then gosh, we want to try to work to help that. The housing affordability question is based upon three factors. So when you say housing affordability, it's based on what the dollar will buy. And there are three things that go into it. Price, so what's the price of the home? The interest rate that's paid on the home, and wages. So what we've had over 2020 and 2021, interest rates and wages outpaced price growth and gave us tremendous affordability. Now, where are we sitting today? Prices are up. Many people are like, feels like it's a little out of control. Interest rates are up and they're crushing affordability. All right, so what do I believe about that? What do I believe about prices? I'll tell you what I believe, but everybody listening to this call needs to form, here's what I would say. In today's market, dealing with people and understanding what's going on, forming a relevant market opinion based upon fact is what is required. There are a ton of opinions in our business. I'm not going to debate that. But an opinion based upon fact is sort of few and far between. So what do I believe about prices? I just told you, you can go to the Keeping Current Matters website. We're entering into a much flatter market relative to home price appreciation, somewhere in the 3 to 4% range. Okay, so that's that. What do I believe about interest rates? Well, in the short term, they seem like they're going higher, but what do I know about every recession in this country? It's brought interest rates down. That's what's happening. What do I believe about wages? We live in a time where wage growth is increasing. So it's that way today. It will not be that way forever.
Very good insight. Very good insight. Speaking of interest rates, obviously that's on a lot of real estate investors' mind and consumers and anybody looking to buy a house.
Sure.
Where do you see interest rates going over the course of let's say the latter half of this year and into 2023? What are you reading, aggregating, and what is, your opinion of where interest rates are going? I think that people probably ask you that every day. So
yeah, I'll tell you this: forecasting interest rates is a fool's game. First of all, I don't have a crystal ball. I will tell you this. Let me give you a couple things to watch, and depends on what you believe. What do you believe about inflation? Inflation is the enemy of long-term interest rates. That is the bottom line. So do I think inflation is going to go away tomorrow? No, I don't. Do I think there's the old, sort of price to pay for the monetary policy and money in this country? And I think we're going to have to go through that. The question is, how quickly? I think we're in for a market for the next several months that's going to see higher interest rates into the spring. A lot of economists are calling for the thing that the Fed, when they start to act and all this stuff happens, it just ratchets up these fears of recession. So, the predominance of economists say, hey, in the first half of next year, we're going to see a recession in this country. So if you play that out and you say, okay, let's say we're in a high rate, I'm going to call it a high rate environment. Historically speaking, we're not in that, but over the last 2 years, we've gone from 2 3/4 to 6 or 7 right now. I think as we go into that recession, what the Fed knows is that the U.S. economy will not recover until housing leads the way out. That is a fact. And the Fed's trying to crack the economy right now. So we have a very dicey situation. And part of that crack is they want to crack housing. They've been very clear that they want to see a reset in housing. Jerome Powell, as the Fed chair, came out and said that. He said, we need a housing reset. And that's what they're aiming to do. So I think right now, I think we're short term in an environment where we're going to see higher rates, but I think we will. I don't think we'll see 2.75 anytime soon, if ever again. Let me be very honest. But I think a normalized environment of 4% is probably a year or two away.
Yeah, really good insights. What we got a couple questions here. I was just scanning the questions, trying to find some themes. A lot of our investors own rental properties. Some own apartment buildings. Talk a little bit about rental growth. And I know this is very dependent on the local market, so it's not an easy question to ask, but where do you see rents over the course of the next couple of years?
Rising.
Yeah.
Next question. I mean, that's the bottom line. I mean, it's, if you can't buy a home, what's your alternative? You got to go and rent. It's as simple as that. I don't see an environment where if we're talking about affordability challenges and high interest rate environments, that pushes people to rent. That's the bottom line.
Scott asked a question that's interesting. He says, is there truth to the sentiment that millennials aren't interested in home buying, or less interested than, I guess, the other classifications of individuals?
I think people came out of, so millennials were the generation that were kids and, growing up during 2008. They saw their parents get, beaten down by the housing crisis. And there was sort of this, this is very interesting. It's a great question. I don't know who did you say asked it?
I just deleted the question. I think it was Scott.
Scott, great question, Scott, because I want to kind of draw a word picture for you. So what happened in 2008 is these kids that were millennials saw their parents go through the housing crisis, and there was this thought and I'm not saying it wasn't true back then, that, they don't want to buy homes. They don't want to get hurt. They don't want to see that. They're going to live in the 2-bedroom apartment above the pizzeria, and, they're going to just kind of live their lives. This gives me chills to say it. That happened back in 2008, 9, and 10. And people sort of said, is buying a home the American dream? You remember that? I mean, it was kind of in question back then, if we're honest. People were like, I'm not sure I want to buy a home because it's not an investment. Homes just lost 20%, and you're an idiot if you buy a house. That was kind of the sentiment in this country. What did the pandemic prove? That everybody said, I want my own spot. We almost saw the direct opposite of 2008 happen over the last 2 years. People said, I don't want to be in an apartment. I don't want to be in this place that I'm in. I want to be in something that I own. Why? Because a lot of us were like, if this ever happens again, I want my spot. And we saw almost the inverse. So I think it's a great question, Scott. And I think there was this sentiment 10 years ago that were like, I'm not sure millennials are going to buy houses. It is, and we have the data to prove it. What I just told you, 81% of first-time home buyers last year were millennials. So not only is it true in what we experience, it's absolutely true in the data that we see too.
Yeah, I think I know the answer to this question, but I'm going to ask it anyway because, a lot of people may have kids and they may be graduating from college or coming of the age where they might be interested in buying a home. What advice would you give to people there versus renting right now?
Oh, it's funny. I was on a podcast. They asked us. So I've got a son in college. We had this conversation. My advice to him: buy a home as soon as you can.
I think one of the things that's interesting is they talk about the wealth gap between homeowners and renters, and it's a significant gap. And agents use this a lot that I've seen when they're working with clients that are a little unsure of whether they should buy or not, right? I see it in a lot of their marketing materials, and I think it's a very effective. But I mean, if you think about it, if you had bought a home in early 2020, you'd be very, very happy that you bought, because your house probably appreciated, depending on what market you are, 50 to 200 grand and what size house you have. I mean, that's a significant wealth gap between someone who bought versus somebody who just said, I'm going to rent.
Well, you remember last year, people were sort of going, should we even buy a home right now? It feels like prices are out of control. There's not a person in this country that if they could go back 12 months ago and buy a house right now, they would absolutely buy it. Yeah. Here's my question. People that wonder, should I buy a home right now? My advice to my son is, hey, when you figure out where you're going to be, buy a house and then don't sell it, right? If I could go back in time, Carrie and I, we bought our first house 22 years ago. I'm like, man, I wish I wouldn't have sold that house. And most people tend to feel that way. But here's the question. If you could go back 10 years ago and buy a home, would you do it? Most people are like, yes. And how many would you let me buy? That's the question.
As many as
So
possible.
here's the question. What makes you think it's going to be any different 10 years from now? And you may say, well, David, I think this, this, and this. Okay, well, then let's talk about that. But that's what you have to really think about. People are hung up right now. Could this house be worth 1% less next month? Maybe. There are some markets that we will see that are overheated. Did some people over the last couple of years that bought homes or did something, did they pay a little bit too much for a house? Probably so.
Mm-hmm.
I think you're fine in 5 or 10 years. Absolutely. Do I think you're fine in 2 years? Yes, I probably do.
Yeah. Interesting question here from Lee. What challenges will home builders need to plan for overcoming and how over the course of the next couple of years?
Yeah, I think we're seeing lumber prices come down. They've had a challenge with supply chain issues. I think the biggest issues that builders and developers are going to face is just the land issue. Where are they going to build them? There are markets where there's availability for that, and there's markets where there aren't. I think you're seeing more people migrate to areas where they can buy a home affordably. I think that's going to be the migration, in this country. There's also a very interesting phenomenon happening in this country, and they call it sort of the term they've given it is birds of a feather. And you're seeing people migrate to states where they feel like they're more aligned politically. And they're like, hey, I'm going to go here because there's more of my people there. And so I think builders, based on those trends, are going to have to adapt to them, no doubt.
Yeah, really, really. We got a bunch of interesting questions. They are all over the board. Someone was asking me if we've adjusted our after repair value calculations and buying, and we're definitely being more conservative right now. We've seen significant appreciation. I mean, to the point where we would buy a fix and flip property, we would calculate the after repair value, we take ownership of the property, start the construction, and recalculate it a month later, and it's gone up, a significant amount. We're not seeing that, and so we are definitely being more conservative. That doesn't mean we're not buying. We're definitely buying, but we are absolutely being more conservative on the after repair value. Someone asked about foreclosures. What's your thoughts on foreclosures over the course of the next year? Interesting question.
The question, are we going to see a bunch of them?
It's kind of a broad question without much definition beyond that. So I would assume that's what they're thinking. We're going to see more. Is it going to be flat? We're going to see less. If we expect houses to appreciate 2-3%, are we going to see more foreclosures, less? Is there any thoughts there?
Yeah, no, I definitely have some thoughts there. Let me share my screen because I'm pulling up a couple of slides that I want to show you.
Let me figure out how to do that again. Hold on, all of a sudden I'm drawing them. Where? Hold on, I gotta find you. There you are. All right, here we go. You should be able to. Let's see.
Yeah, it looks like I can now. Yeah. So okay. Let me set this up. So I want to walk you through. This is a question that comes up all the time. Relative, is the market going to crash? And it's hard to find somebody reputable right now that says the market's going to crash. Are we starting to see pockets of depreciation? Yes, and Zillow just reported or released a report on MSAs relative to appreciation and depreciation. I can talk about that, but let's talk about foreclosures. One thing you got to look at in this, and I'm going to give you a couple of things here. Can you see this? Lending standards are still under control. So first thing you want to look at is, okay, what's happening with lending in this country? Very, very different from what we saw in 2008. This is a mortgage credit availability index, and it registers how easy is it to get a mortgage loan. So the higher the index, the easier it is to get a loan. Where are we at? We are significantly lower than where we were back in the housing crisis. The joke always is, it used to be easier not to get a loan than to get a loan back in 2008. And what have we seen during the last 2 years? We've seen credit standards constrict, right? The last thing I want to do is lend money to somebody who's going to lose their job during the pandemic. Now, here's where it gets interesting. Most people miss this. It's not covered in the media. It's not out there. When you have a better qualified borrower, you see less foreclosures.
Yeah.
It's a novel concept, I know, but whenever somebody can, repay a loan, they don't default on it. Now I'm going to show you what defaults look like in this country. This is a look. Oh, wrong one. That's foreclosures are up, but near record lows. Let me show you this foreclosure activity right here. This is the one I want to show you. Since 2010 in this country, we've seen less foreclosure activity every single year. And now you can say, hey, David, the past does not indicate what's going to happen in the future. And I absolutely agree with you. Okay. And even take 2020 and 2021 off the map because they're anomaly years. But this decrease in foreclosures you have to look at because it signifies a better qualified borrower. Okay. Now, where do we stand right now? A couple of facts that I'll give you. I'm going to give you the latest ADAM data, who they monitor foreclosures in this country, but the facts of the forbearance program coming out of COVID is 4 out of the 5 people that went through it came through it whole. They either paid their loan off, they went through a modification, they did whatever they wanted to do with their bank, and they came out. Okay. There are some that are in trouble that are going to have to short sale and do things like that, but not the predominance of those people. And oh, by the way, the people that maybe are in trouble coming out of COVID, they have options. Homes have appreciated to the point where you could sell your home and hopefully put some money, cash in your pocket and get to the other side of the financial crisis that you're facing. So here's a shocking number that I'll give you. This is from ADAM data right here. Only about 214,800 homeowners were facing possible foreclosure as of the second quarter of this year, or just 0.4% of the 58.2 million outstanding mortgages in the US. Of those facing foreclosure, 195,000 or 91% had at least some equity built up in their homes. Think about that.
Yeah.
These people have options. Listen, I understand foreclosure as a business and it happens. We don't wish it upon anyone. And it certainly has been a business strategy for many. It was a big business strategy coming out of 2008. I do not see this wave or predominance of foreclosures in this country because it's not substantiated by the numbers. If you go and talk to a mortgage company, they'll tell you they're okay with about a 1% default rate inside of their portfolios. That's generally what they're okay with. Okay, so you have this portfolio of loans, we're okay with a 1% default rate. We're at 0.4% in this country. We're not even knocking on the door of standards they would be okay with. If anything, mortgage companies are probably like, you know what, we could afford to lend a little bit more money and be a little bit more, elevated on our risk sort of profile on a borrower. But we do not have a situation in this country where we'll see this. And I want to show you one other thing before I turn it back to you. This came out last week and was shocking to me. And I hope everybody will take a picture of this. Again, I'll give them to you, Thad. You can get them out to folks. U.S. households right now own 41 trillion in owner-occupied real estate. And that's just over 12 trillion in debt on that 41 trillion. You remember in about the last year, there were headlines, 10 trillion in real estate debt in this country, and we're in trouble. Yeah. Like, we've never seen a number that high. We better watch out. Where there's 29 trillion in equity in this country. The national LTV is 29.5%. Think about that. It's the lowest it's been since the early 80s. The average homeowner with over $300,000 in equity. So
I would have never guessed this. This is,
it's shocking.
Yeah, it's so 29.5. Wow. Tremendous amount of equity.
Totally. And so if you think about that, there is not a case to be made for a massive amount of inventory to hit the market in some sort of distressed fashion. Will they be out there? Yes. Will there be opportunities? Yes. But this is not going to be this wave of properties coming to market. And matter of fact, let me add to that. I don't see banks right now in a posture of wanting to foreclose on people. They're probably going to call up and say, hey, we're thinking about foreclosing on you, but we'd really like it if you'd reach out to an agent and get the house sold and we can be done with this. They don't want any, after 2008, they'll do whatever they can not to take back a property. Is it going to happen? Sure. But when you start to break down the market, it is shocking.
Yeah, that's really, really shocking. I mean, I knew people had lower LTVs than most people thought, but 29.5% to me is
well,
really
it speaks to a couple of things. One, post 2008, homeowners have clearly said, we're going to do it different this time. We're not going to go out and do the cash out refi and buy a jet ski and go on vacation and do whatever else we're going to do. We're going to pay attention to the equity in our home. And it's loud and clear. It's loud and clear. There are two things in the real estate world that we don't know the effect of right now. And I'll tell you what they are. First is this money. We don't know what's going to happen with this money. Okay, something will happen with it. Will folks invest in properties? Will they want to become investors? Will they buy a second home? What will they do with that? So that's a question we don't know yet. The second thing we don't know the long-term impact, and I do believe it will have an impact, is the predominance of people that are sitting at an interest rate below 4%, I'm going to say. Many of those are like, hey, we're good.
Yeah.
We'll add a room onto the back of the house. We'll do this, we'll do that, but we're not going to give this up. I do think there will be some opportunity. It's something we don't talk about, but I think it will be an opportunity in assumable mortgages. Go and assume a mortgage that's on a piece of property. So I think there are opportunities out there and some things that I think we'll look back on the last couple of years and say, you know what, it had a pretty big effect on real estate in this country.
Yeah. This is a good question that came in here from Dina. Does a softer or slower real estate market make it easier for investors to negotiate prices with sellers? I mean, the answer compared to in the middle of 2021, obviously you had no leverage as, very little leverage as a buyer because there'd be multiple offers and you just are competing on price and relationship with. So yeah, you're going to have more opportunity. I mean, I'd say what we're seeing is it's a more normalized market. We're not seeing a crazy number of offers on every single home that we list and sell. When we have a fix and flip property in 2021 and the number of offers we get in a week was shocking. Now it's much more in alignment with what I've seen over the course of 18 years, I would say, from a days on market standpoint. So I can't say it's like a market where you're all of a sudden getting these crazy discounts, because it still depends on what city you're in, but that's what we're seeing. Here's a interesting question. I don't know if you have an answer for this. It's kind of a through the pandemic, the second home market exploded. What do you see for that market in the near future?
That's a great question. So in 2020, the second home market was actually forecasted to constrict. Okay. And we went through 2020 and everybody's like, we're getting out of town and we're going to go buy a home in the mountains or at the beach or whatever the case is. That is a market right now that we have looked at and said, it could have a chance to go through some type of decline or reset. I don't think you're going to see anything massive. Now, here's the other thing. What I just showed you in national LTV, there are a lot of people sitting on a lot of money that say, we might go out and buy a second home. So I think it is a market that we're watching very closely. And I think there are a lot of people that bought homes in the second home market over the last 2 years that may come up on the next year or two and say, do we really want to do this? So I think it's one that we want to keep watching.
Yeah, really good information. David, why don't you just share briefly, how you help agents, investors, or just people stay up to date with keeping current matters?
Yeah, sure. So, here we're in Richmond, Virginia, here at Keeping Current Matters. We've got 45 people that support this mission to gather all this information and give it back to you. Okay. And one thing I'll say is I think people that we work with, what happened during the pandemic is we began to want information more readily. We want to know the information, certainly in our business, and we want to deliver that to everybody and help you make sense of the market. Because I'll go back to how we started. I don't think we get that in the news. We don't get an honest take of what's going on. Even think about the foreclosure piece. That's not promoted out there. And I'm not saying they need to talk about foreclosures, but we want to bring the truth. So a couple things you can do. You can sign up for what we do for $29 a month and get all this information. Or you can go to the KCM blog. It's just kcmblog.com and sign up for free and get a blog in your inbox every morning, and just stay on top of it. So our mission is to help folks make powerful and confident decisions with the real estate they're buying, they're investing in, they're owning, whatever the case may be. And anything we can do to help you, Than, and the entire group, and be there as a resource to say, okay, I know what's going on, I know what's happening, is our goal.
Thanks everyone for joining us. Thank you, David, for joining us today, and look forward to seeing everybody at Real Estate Ignite. Thank you, David.
Thank you. Have a great day.
Take care, everyone.
Wow. Hopefully you enjoyed that as much as I did. I know I took a whole bunch of notes. I actually went and got a second cup of coffee to make sure I stayed riveted to what Mr. Childers was saying there. Absolutely phenomenal information. And that's what we love to do on the Fortune Builders Real Estate Investing Show, is bring that type of information that's timely and current to you, so that you can take that information and education, but also implement it into your business. And as always, if you want more information about Fortune Builders, if you're looking for a bit more of a one-on-one relationship to help you take that education and implement it into your business, you can always go to FortuneBuildersShow.com, see all of our previous episodes, but also figure out how to implement this education into your specific business. Wow, what a great episode. Tons of great information there. Hopefully you enjoyed it as much as I did. I'm going to sign off this way like I always do. Take care of yourself, and in today's world, if you can, take care of someone else too. Cheers.